Welcome, Anders. It's been a volatile couple of weeks for the markets, and we've said that this might be one of our more difficult updates. But let's dive into it. We've had a couple of weeks with Trump, and if we start out by thinking about the U.S. economy, how is the U.S. economy?
Well, I think it's important to state that the underlying health of the U.S. economy is very healthy. Investments have been strong over a couple of years, driven by productivity increases, profitability, a wave of investments into AI and cloud facilities. So US growth is supported by investments. We've also seen during 24, and I think that will be strengthened during 25, that the US consumer is in a healthy spot. The labor market has remained very strong. We're getting new numbers today, but on the overall perspective, employment growth is there. Unemployment has remained low. We've seen real wages come back, and I wouldn't say that the real wage increases are unsustainable given the high productivity. So consumption is well underpinned by increased real wages, strong employment, low unemployment, and also a gradual decrease of interest rates. So the starting point, both on investments and consumption for the US economy, is healthy. And I would add that it's actually more healthy than most other regions in the world. Europe is clearly lagging behind on growth. China is struggling with the real estate crisis and have not been able to perform the same type of productivity increase that the US have seen. So in a relative sense, the US economy is more healthy than most other global regions.
If we turn specifically to equity markets, then what are you seeing there?
Well, we end the week here with S&P 500 at 6,000. That clearly indicates that the US market has been doing well. The financial sector, very good quarterly reports, net interest income, very sustainable, optimism on new deals. The software sector, I think, have delivered very good results on an overall perspective. There's been a few market disappointments, but cloud growth is there. Investments in new facilities are there. Profit margins are there. So if you look at Amazon or Microsoft or Meta or any of the other tech companies, they remain very healthy. We also have consumer services coming back on with support from higher consumption. And clearly we can see a lot of the sectors like defense and energy doing fairly well in the US. So I think from a stock market perspective, we're healthy. We have some more problematic and challenged sectors like automotive, utilities, real estate and construction. But I mean, from an overall perspective, I think the stock market is in a pretty healthy position. The worrying part is obviously the valuation. I mean, profitability is there, sales growth is there, but the market is already very highly valued. So a healthy market, but a bit of worry about the valuations.
Yeah, and going into the 20th of January, we knew that we had discussions coming up regarding tariffs, and you've said that we're off to the worst possible start. Would you elaborate a little bit on that?
Well, I think there are positive aspects of the new US administration. The regulation and tax cut could support the stock market and the US economy. But in terms of the trade war, I think we're clearly at the worst possible start. In terms of trade war, the most important factor is what type of tariffs the US is implementing on Canada and Mexico. It is Canada and Mexico that have really big weight, both for the two economies, but also for the US economy. So if you have 25% tariffs on Mexico and Canada, this will imply that the price level would increase something like close to a percentage point, and probably GDP would drop at least 3/4 of a percentage point. Obviously, the levels will drop over maybe 2 or 3 years. So you probably should expect an inflation increase of something like a quarter to half a percentage point and 25, and then also additional price increases in 26 and 27. So if the US doesn't have a trade war with Mexico and Canada, the impact on the US economy and on inflation and interest rates are fairly small. We don't know now. Trump has started with 25%. For me, that was a risk scenario. He has backed down. We don't know if this was because of the S&P 500 reaction, if this was just a negotiation play, or if it was because Trudeau and Canada and Mexico really put up some damaging retaliation measures that they could have implemented, and therefore Trump backed down. So we don't really know where we are. And this is not really a trade negotiation. It has everything to do with US borders, US security. And then you have to note that this is basically a question about the Mexican border. There are very little illegal drugs coming from Canada. And there is also very limited illegal migration from Canada. So it's basically a Mexico issue. It could be that Trump later in February, March says that he's satisfied what is being done with the border, and then he settles. But we don't know if he's settling at 25, 15, 10, or no increase of tariffs. So we will live with this fairly large uncertainty on the impact on the US economy and North America in general. One has to also understand that it is these discussions with Canada and Mexico that will have the biggest general impact. Because, I mean, obviously, if you look at interest rates and monetary policy, if you add a quarter to half a percentage point in inflation, Fed would be very reluctant to cut rates in 25. It's pretty obvious that they won't move in March, but we don't know how much clarity we will have in March. So as long as this is an uncertainty, I think Fed will really want to see data confirming that this inflation is ongoing, that the labor market is cooling, that wage increases are coming down, and that productivity remains healthy. So a much more cautious monetary policy. I've been a central banker. You can always argue that you should look through one-off increases in the price level, but you have to also add the fact that the US have a tight labor market and that we're really depending on strong productivity growth not to have a cost problem. So even without the tariffs, I think Fed was now moving into a phase where they are more cautious. With the tariffs, it's pretty clear that they will be in no hurry to cut rates and move very gradually forward.
Clearly worrisome for North America. If we turn towards Europe, then what do you see as we look ahead towards possible trade war with Europe?
Well, to start with, it's important to note that Trump has a lot of countries that he can start trade wars with. So clearly, this is a process that could be ongoing for months, maybe this whole spring and maybe even to summer. So the uncertainty could be there for a prolonged period, and that makes this very difficult. Well, a trade war with Europe, if we're just looking at a 10% increase, that would have a marginal impact on US inflation and a marginal impact on European inflation. I think some of the US investment banks calculated that out of the 25% of European revenues that are affected, it's less than 5% that is heavily affected. Roughly 10% is services, and roughly 10% of the revenues are coming from production in the US. So we're down to 5-6%, and out of that, maybe half is sensitive, because maybe roughly half has a pricing power and could kind of roll the impact of the tariffs over. It's important to note that if you read what happened in Canada as Trudeau really threatening Trump and he backed down, well, that could imply that Europe thinks that they should replicate that behavior and come with fairly strong retaliation measures. Clearly, that could escalate with Trump adding additional tariffs. It's very important to note that tech is in the forefront here, because in normal periods of uncertainty, we like the big tech companies because they have growth, profitability, a platform for innovation. But from an EU Commission perspective, it's pretty clear that there is already a conflict with big tech, so that could escalate. And the tech companies are highly valued. They are in a vulnerable phase with really, really large capex. And if you would imply that they can't really sell as much cloud and services to Europe, that's obviously a dent on the ROIs on these large capex. So the tech sector is vulnerable in the US. For Europe, the automotive sector is vulnerable. It's not in a good place to start with. Clearly, the competition from Chinese EVs are undercutting some of the German and French and other European car producers. But then we have a potential for increased tariffs that would, according to most research, hit the high end. Companies like Porsche, Ferrari, McLaren, BMW, Mercedes, and so forth. Some of them are more and less vulnerable to production in Canada and Mexico, so that could add a bit on that dimension. There is also a risk that Trump goes back for luxury goods again. That's a big French sector, and the French will obviously be the one that will try to escalate this trade conflict. So the European luxury brands, I would say, are a bit vulnerable. They normally have high underlying profit and growth, so it's a kind of a good sector, but obviously more uncertain in a trade war perspective. We also have a large European pharma sector, and we don't really know how that will play out. So there is a risk that the playbook from Canada escalate to make Trump back down is being replicated in Europe. And clearly Trump has to be understanding that if he's always seen to just back down, he will lose his credibility and the threat potential. So maybe he will escalate in a second round with Europe. So this could be, I would say, fairly complicated. On the positive side, I've said for months that there is a potentially a trade deal in the bottom of this. Europe can increase its defense spending, buying more US defense equipment. Clearly, Germany are in a position, particularly after the election, where they could buy more LNG from the US. That's a really big factor in the trade dynamics between US and Europe. Europe can also take a bigger responsibility for a potential rebuilding of Ukraine and support of Ukraine. And there is a bit of a possibility for a peace deal that could kind of be a booster for Central Eastern Europe. So there are pluses here, but I would say a trade war between the US and Europe could potentially be a factor of volatility and uncertainty, and potentially also have, I would say, much smaller impact than Canada and Mexico, but not negligible. It could be a negative factor both for Europe and US, and particularly given how weak Europe is now, that is not what we need.
A lot of considerations going forward for Europe, and some different considerations if we turn to Asia. How would you like to summarize those?
Well, it's also very complex. Trump has shot the starting shot for this trade war with China. China has responded without escalation. So that hasn't gone really bad yet. There is potential talks between China and the US. So this could kind of peter out, but that we don't know. There is also potential that Trump will escalate it and kind of change the trade regime and trade legislation for China. If that happens, we're probably getting close to the 60% tariffs, and that would obviously be a more complex environment. But one also have to add Taiwan. Trump has been very clear that he thinks that Taiwan has stolen the semiconductor industry from the US. So he could potentially go for really high tariffs on Taiwan. We all know that almost all advanced semiconductors are produced in Taiwan. TSMC is a crucial part of any tech supply chain. They have big deliveries to all the big US tech companies, and particularly now when NVIDIA is producing a large number of GPUs for scaling up AI. That's a potentially big issue. When it comes to the impact from China, that is much more directed towards light manufacturing. A key question is obviously Apple. They produce a lot of the iPhones there, but this is true for basically gaming consoles to anything that is consumer electronics. So in light manufacturing, overall, China normally has a global market share of 30 to 50 percentage points. So anything that is consumer good light manufacturing could potentially be fairly heavy impacted from an escalated trade war. So Asia, one thing is obviously tech and Taiwan, particularly if there was also be a trade war with Europe, where tech is a part of the battlefield. and then you have the overall impact on light manufacturing, China and so forth. One has to understand that China could easily deflect part of this by doing a rational policy response in terms of their own real estate crisis. If they cut rates, if they go for QE and forces 2 years and 10 years rates down below zero, clearly that would get the real estate sector in a better shape, but it would also imply that the RMB would devalue, and RMB devaluation to 750, 775 or something like that is complex because it has implication for overall trade flows, emerging market, financial stability, and so forth. So, and disorderly depreciation of the RMB is adding potential uncertainty here.
A very complex picture that you've painted with a lot of dependencies. I guess it begs the question now to turn to investors and how do investors act in this extremely complex and volatile environment?
Well, I mean, one potential scenario is that Trump is just negotiating the art of the deal that people talk about, and then this could de-escalate in February, March, and peter out, and then the US economy is in good shape, the global economy is recovering, China is improving, Europe is kind of at least getting some traction. So in such a scenario, the situation is fairly positive. This could also, particularly in February, March, and April, escalate to a broader trade war with escalations in different regions and impacting different sectors. So I think we are in a situation that is very complex with high degree of uncertainty. So obviously, from an investor point of view, when you have uncertainty on interest rates, currencies, commodity prices, well, you have to actually reduce your risk level a bit. So anything that you feel uncertain about, or if you have leveraged positions, I would be very cautious. So a reduction in the overall risk level, at least until we get some more clarity, I think is called for.
You often talk about quality companies and remaining in quality companies. Is that where we're saying for investors?
Well, I still think that quality companies are the best safe space to be in. It's not fully Trump-proofed, but it's the best place to be in. So quality companies normally have profitability at a higher end, which normally implies that there is an underlying sustainable moat that protects their profit margins. That implies that they normally have some degree of pricing power, which means that even if you get tariffs, you can protect your profitability better because you have the moats and the pricing power. Normally, the quality companies have a better and stronger underlying growth trajectory due to some secular trend, whether it's AI or biotech or demographics or health trends or any of the other long-term trends that we like. You normally in quality companies also screen for balance sheet. In this type of situation, you clearly want a company with low debt level and a strong balance sheet that could withstand turbulence. And normally with quality companies, we also mean strong owners that can and are able to back the company in a complex situation. But I would add that when you screen your quality companies as a portfolio manager, you also need to look at the maybes. If there are maybes and if there are extra exposure to the Trump volatility, then you probably should reduce the position even in those companies. So quality companies are, I think, the best position to be in. And let's face it, I mean, the underlying dynamics of the US stock market and therefore the overall global stock market is pretty good for 25. Sales is increasing, profit margins are expanding, and the underlying fundamentals of the companies are pretty sound. So this is not a risk-off situation because you want to be in the stock market, you want to carry the exposure, but within that framework, you need to think deeply on where you want to be. And quality and screening for Trump effects, those are two starting points in my thinking.
You mentioned Trump screening. From a diversification perspective, is there something that you're seeing there that you think?
Well, I think we have to start with the fact that this is a very complex situation. Many of the sectors that we like tech, could or could not be affected. Software companies could or could not be affected. Consumer services, the overall kind of animal spirit in the economy, yeah, that's interest sensitive. So it's really difficult at this stage before we have more clarity to say where you really can feel that you have a good diversification. Given that this is a trade wars that we're talking about, they clearly also have global implication, which complicates things, because normally you would like to think of, yeah, good diversification is moving a bit out of the US, but now tariffs might be kind of double-edged sword. You might like the low valuations in Europe or in China. And in China, you might like a stronger underlying growth and higher profitability. But I would say, yeah, diversification, but it's difficult to at this point with a high degree of uncertainty really point on what is more safe and what is less safe. So yeah, uncertainty, complexity will be there with us at least during March, April. And let's face it, there is no guarantee that Trump is not restarting these trade wars later on. One fundamental positive factor is that Trump is sensitive to market discipline. If he sees S&P dropping, if he sees the 10-year go up, he's likely to back down. So there is a positive factor in the sense that market discipline works on Trump. It's also a positive underlying factor that the US economy is in a really good and healthy position. But those are the two positive factors. That's why you need to stay invested. Exactly how you have to navigate this complex environment, I think we'll just have to accept that this is difficult, complex, with a high degree of uncertainty, and hope that the dust will eventually settle.
Thank you, Anders, for a very good summary. Gives our investors a lot to listen into and to think what that means for them. If there's anything that you've heard this week that kind of really sums up where we are right now, what would that be?
Well, I think we should then focus on the fact that we've actually seen pretty good quarterly reports. That's a strong argument for staying invested, and that I think is the kind of most important starting point.
Thank you.